Hey, welcome. Today we are jumping into a question that sounds kind of technical, but it can actually change the entire financial story of a cooperative. We're going to figure out what a co-op member share really is on the books. Is it a sign of a strong foundation, or is it basically just a debt? Okay, so think about it like this. You join a co-op, you put your money down for a member share. Is that share a real piece of ownership? A slice of the pie? Or is it more like you just gave them a loan, an IOU that they absolutely have to pay back someday? The answer to that question has huge implications.
And this leads us right to what I like to call a co-op shares identity crisis.
Let's really break this down. On one side, you've got equity. That's your piece of the pie. It means real ownership, and it makes the co-op's financial base so much stronger. But on the other side, it could be a liability. That's the IOU. It's a debt the co-op has to pay back, and it just adds to what they owe. And this isn't just some boring accounting detail. How a co-op classifies its shares completely changes how banks, partners, and even its own members look at its financial health. A co-op with a big equity base, that looks safe, it looks stable. But a business that's loaded up with liabilities, well, that looks a whole lot riskier.
So, how do we solve this puzzle? Well, thankfully, there's a really clear official test we can use to figure out what's what.
So what do you think it is? What's the one thing that decides it all? Is it about whether you get to vote or if you get a dividend? Well, the official accounting rule, IFRIC 2, actually says it all comes down to one single decisive factor. And here it is. This is the golden rule right here. It's all about redemption, your ability to ask for your money back. But the word that changes everything is unconditional. Let's just put that in plain English. It's really simple. It just means, does the co-op have the absolute no-strings-attached power to say, sorry, we're not cashing you out right now? If they can say no for any reason at all, then it's equity. But if their ability to say no depends on something else, well, then it's a liability.
Okay, so theory is one thing. Let's apply this litmus test to a few scenarios to see how it really works out in the wild.
First up, our first case file. Let's imagine a co-op where the board seems to have all the power when it comes to paying members back. Let's look at the rules.
So, if the co-op's charter says redemptions are at their sole discretion, that's it. That's an unconditional right to say no. And get this, even if they've approved every single redemption request for 50 years, it doesn't matter. It's the right to refuse that counts. So the verdict? The shares are equity.
Okay, on to our next case file. Here, the co-op's power to say no isn't quite as clear-cut.
See the difference here? The co-op can only refuse to pay out if it would break a law about having enough cash. Because their right to say no is conditional, it depends on their finances, they don't have an unconditional right, and that one little word changes everything. The verdict? Those shares are a liability.
All right, now for a more complex one. What if the rules only block redemption for part of the shares?
Okay, imagine a co-op has 900,000 currency units in shares, but a local law says their capital can never drop below 750,000. Well, this actually splits the shares in two. That 750,000 is an untouchable floor. The co-op can unconditionally refuse to redeem it. So that chunk is equity. But what about the 150,000 sitting on top? The co-op cannot unconditionally refuse to pay that back. So that slice is a liability. Isn't that wild? A single rule can basically create two different kinds of financial instruments on the balance sheet.
So we've seen the rule, we've seen how it works, but let's get to the bottom line. Why does this all matter so much?
Well, let's just lay it all out. If a share is equity, payments to members are like a dividend, a distribution of profit. On the balance sheet, it builds a really strong capital base, which makes the co-op look like a lower risk. But if it's a liability, those same payments are an expense, just like interest on a loan. And on the balance sheet, it just looks like debt, which makes the co-op look like a higher risk.
So if you take away just one thing, let it be this. It all comes down to control. The absolute no-strings-attached power to say no is the bright line that separates a member's share from being a piece of ownership versus just another IOU. And that's our explainer for today. The next time you look at a co-op's finances, you'll know the crucial question to ask. Are those member shares building a solid foundation of ownership, or are they just a long list of promises to pay? Something to think about. Thanks for tuning in.